Thanks for coming, Eric.
You bet. Good to
What
be
are you
here.
in Winnipeg for?
We're going across the country. I feel like a preacher spreading the gospel on energy and just talking about why we're excited about energy stocks, why we think they're mispriced, why oil's in a multi-year bull market for oil, how much upside we see. So yeah, it's been fun.
Yeah, so when I knew you were coming to Winnipeg, I told my dad, I said, we gotta get Eric in the office. I want to chat. I want to ask you a little bit about your bullish view on oil and gas, if anything's changed, because we chatted, I don't even know, I think it was last year sometime, and you gave some very bullish opinions back then. I wanted to know, first off, if anything's changed in your view. You were extremely bullish then. Are you still on a scale of 0 to 10? Are you still a 9 and
Yeah,
9.8?
I'd say we're pretty bullish.
Close to
You know,
10?
you think about it, when we talk, I would have said then and I say now. There's four things as an energy investor you've got to figure out. You've got to figure out demand, which I'm sure we'll talk about, recession, what does that mean, etc. And then supply, U.S. shale outlook, OPEC, and the global super majors. And so when I think about the demand for oil, even under recession, we think demand's going to grow globally. If you reflect on people just get obsessed about the U.S. because we get data every week and such, and there's no suggestion of a slowdown in demand there in aggregate. We look at China emerging from lockdown, where they were suppressing demand by 1 million barrels per day last year. You look at in real time now, last month, road congestion's back to pre-COVID levels. You've got domestic flights back to pre-COVID levels. International flights by the end of August, give or take, will be back to normal. So that's 1 million barrels per day. We've got seasonal weakness where Q1 is always the worst. It is every year, so that's progressively getting more. Refineries coming back online. So we feel good on demand. When we think about U.S. shale, where we've saw shale growth disappoint throughout much of last year, you've had the luminaries themselves, the shale CEOs, cutting their own growth forecast because they're having to fess up and say, well, look at well results are getting worse. Wells are getting gassier, wells are getting more expensive. We have inventory challenges. Maybe why Exxon supposedly might be bidding on Pioneer, which is the longest life shale reserves. So we see shale really faltering, like not being able to grow like it has in the past. When we think about OPEC, we see in aggregate their inability to grow supply meaningfully until 2025, where the UAE is adding 1 million barrels per day. And then we have Saudi Arabia adding another million in 2027. No other member country can add it. And you've got the head of Saudi Aramco, the most sophisticated oil company on the planet, warning the world, saying, look, we all have to start investing more, but it takes time. It takes 6-7 years. I got to go to meet with the energy minister of Saudi Arabia in January, and not getting specific what he said, but my general sense was their ministers in the Middle East are concerned.
They're concerned that they're not going to be able to
can't meet the world's demand. We just had the EIA, so the U.S. government today, say, well, demand next year is going to grow by 1.8 million barrels per day. Where's it going to come from? At best, it's going to come from spare capacity of OPEC and a little modest shale growth.
Where's the number at now in terms of daily demand?
We think it's around 102 million barrels per day.
102.
Yeah.
And so that's like a 2% kind of increase. So that's not, you said 1.2 per day, right?
Yeah. So 1.8. That's what they're saying
1.8.
for next year. We can all debate this year in terms of, well, how much, the pace at which China is going to normalize, because they were down by 1 million. A lot of people talk about U.S. recession. What are we going to see for demand loss? One firm we use is called Energy Aspects. They're really globally renowned. They're modeling a recession in the United States. They're modeling a recession in Europe. And they actually do have demand falling by 600,000 barrels per day. And they admit, well, we might be being too bearish, but we want to be conservative. But people forget, like for the past 20 years, the story's not about Europe. The story's not about the U.S. It's all about emerging economies where they're 106% of demand growth for the past 20 years. So they've got emerging economy demand this year of 1 million, China growing 1 million, some loss from weak economy, recession, etc. But it still means an undersupplied market. And then we have the OPEC cut, where they just cut production by 1.1 million barrels per day effective May. So people aren't realizing that we were already on pace to end this year at about a 7 to 8 year low in terms of inventory levels globally. Well, this cut by OPEC just doubled the pace of withdrawals from storage between now and year end. So it's very, very bullish. I don't think a lot of people are bad at math and they can't connect the dots and just see where we are going. Well, if we were undersupplied 1.5 million, now we're 2.5. And what I think it's going to result in is a market that OPEC is over tightening. They're going to have to unwind by year end because the price is going to go up a lot higher.
Eric, the average people I meet on the street, or some of our retail clients, when we talk about oil, and let's say they don't like oil, their main argument is saying, yeah, but we're going to need gasoline in 10 years. Every car is going to be EV. And so what do you say about that? Like how much, if every car on the planet was EV
Yes.
in 10 years from now,
Yeah.
what's your scenario about it?
We'd be down 27%. So the gasoline is about 27% of total oil demand, which I think probably catches a lot of people off guard, because we've used it every day, we fill up our tank once a week, and the average person suffers from what I call energy ignorance, which I define as the lack of knowledge of how is oil used, and then the likely time frame to displace it with alternatives. So let's talk about EVs. Let's talk about cars, a whopping 27% of total oil demand. So there are 1.4 billion internal combustion engines right now. EV sales globally last year were 8 million, and there's signs that the momentum starting to falter. But let's just ignore a lot of our energy realities, because politicians certainly are. For us to all drive EVs, we need a lot more electricity. We need to increase the grid and such, really copper intensive. To hit government goals, we have to mine the same amount of copper over the next 20 years has been mined in history. And that's just one obstacle. So yes, governments can say, well, we're heading here, we're going to ban internal combustion engines by 2035, we're going to mandate these. But I think ultimately the energy realities are going to mitigate that. But even, let's just say, we're all driving EVs. Where I think people falter is not recognizing that 40% of oil is non-transportation. So you're talking about petrochemicals, plastics, like what does an EV drive on? It drives on rubber tires and asphalt, both of which come from oil. And that demand grows as the world's population grows, which the UN says 27% by 2050 when we're supposed to reach net zero. So this concern that people have, whether it's hydrogen displacing diesel or EVs displacing gasoline or God knows what displacing jet fuel, because you can't take a battery powered plane across the Atlantic. Even if you buy into that, the timeline to meaningfully impact oil demand is a lot longer than people believe. And then when you relate it then to what energy stocks are valued at, you don't have to be bullish on. To believe in where we already trade, roughly $80 now, and the average company can privatize itself in 5 years. So don't worry what things look like in 30 years from now, when these companies could privatize themselves, 6 years over between now and then. There's such a gap between what stocks are being valued at versus where we trade and where we're likely to go.
Yeah, we had Rafi in here talking about this exact thing a couple months ago, and his main theme was very similar. So, you're taking a very macro view on what's happening to the price based on supply and demand. But like just the straight up valuations of free cash flow right now, I think is, well, I don't know, but I see you a lot on BNN. That's probably the strongest argument to be bullish on oil and gas stocks, probably more than the macro side, right? Just the valuations,
Yes.
because it's so out of favor. Nobody wants to buy these right now, right?
And everyone is still very underweight, despite this having been the best performing sector for several years. Like we've been the only game in town, frankly. Like if you haven't owned energy, you've massively underperformed. And when I look at the sector, what you're getting is exposure to balance sheets that are the strongest in history. We have the average company in North America being debt-free by this time next year at $80 oil. You've got the most amount of free cash flow being generated in history. And I take some pride in having massively helped create a catalyst to drive the re-rating in stocks, because you can have a cheap stock. It's a value trap. It's a cheap stock that stays cheap forever. Or you can have a mispriced stock that gets re-rated. And the difference is a catalyst. And so that catalyst is the sector pledging low to no growth, maximum free cash flow, and returning the vast majority, if not all of that free cash flow back to us in the form of either dividends or buybacks. I'm in favor of buybacks because it has to drive the rating, because my pitch to boards is, what's the value of your last share? In some cases, a big holding of mine, they have 35 years of reserves. Well, they could privatize with 3 to 5 years of free cash flow at $80 to $100 oil. So I'm getting 30 years of reserves for free. Well, they free cash flow $1.1 billion at 80 and 1.5 at 100. So the value of the last share is worth 33, let's say 30 to $45 billion. And so if people continue to suffer from that energy ignorance, they say this is a sunset industry, we're transitioning, we don't know what to what, but I hear we're transitioning, we're banning plastic straws and we're not using plastic bags at the grocery store and such, and this is a dead industry, etc. It doesn't matter. So long as companies adhere to my philosophy, use every nickel of free cash flow and privatize, because I'm going to be the guy owning that last share.
And are they?
Clients. Absolutely. The entire sector.
Because there's no
With-
CapEx anymore, right?
There's maintenance CapEx. And so what my pitch to the boards is, what's the surest way to drive that re-rating? And it's buybacks. So it's a religion now of the industry, where from the smallest to the biggest, from the Nuvistas to the Synovises, are all saying once we reach our final leverage metric, which is happening in real time, we as investors will get 75 to 100% of that free cash flow. It's unbelievable.
Is that sorry, go ahead.
No, I was just on that topic. Okay, most people don't understand that we can privatize in 3 or 4 years, exactly what that means. So the guys are going to buy back their shares instead of reinvesting it like they used to. Okay. And, but at some point, okay, so are you saying that they're never going to need capital again because they're buying back their shares? So they're not going to sell equity to raise money, right?
Yes.
So those companies that are buying back their shares, they're not going to need equity anymore?
No. So we look at my average holding. They're sitting on 17 years of stay flat inventory. So they have enough inventory to keep production flat for 17 years. So they don't have to spend a nickel on M&A. On average, they'll be debt free this time next year. So you don't have to raise money to pay off debt or whatnot. And the model, why did shale grow by the magnitude that it did back in 2014 and 15 and 16 by as much as almost 2 million barrels per day? It wasn't that they had such great geology or technology was so wonderful. For every dollar they generated, they spent almost $1.50. So that extra 50 cents came from equity raises or banks. Well, if you're underspending cash flow because you've got some crazy guy in Toronto demanding it as one of the largest energy investors in the world, and people have bought into that catalyst acting as the re-rating, you don't need external sources of funding.
Do you think it's happening more as share buyback or special dividends?
Primarily buybacks. People talk about, well, we haven't seen it yet. There's no correlation between share price performance and buybacks.
Yeah, but that's
the word that I use is meaningful. You're not going to get an impact from buying back 5% of your stock. That's not what I'm talking about. People had to be patient for 2022. Free cash flow was high and companies were paying down debt. So they were right on the cusp of hitting their leverage metrics, and then oil sold out because of recessionary fears. And, this year we had the biggest liquidation in crude contracts in history, where we got to flush out, fell $10 in a week, etc. So the oil price hasn't cooperated temporarily. We just need a couple more quarters of $80, $90 oil. Companies will hit their leverage metrics by the end of this year, and then you'll see that inflection from 50% to 100%. And then, like when I talked to the CEO of Synovus 6 months ago, I said, Alex, thank you so much. This was when they pledged 100% of free cash flow to go back once they hit the $4 billion. And I said, thank you so much, because this gives me a real stick to beat the smaller guys with and say, look, this is what one of the biggest, most well-run companies is doing. And he said, Warwick, what else would we do with the free cash flow?
Well, you're out of choices, right?
You're out of choices. We don't have to buy anything. They've got 30 years of inventory. We're not going to grow because our shareholders will hate us forever if we do that. We don't have to pay down more debt at that point. What else do we do with the cash? And so that's where the second half of this year in 2024 is going to be about, where a large cap can buy back at $100 oil 30% of their shares, so they can privatize with 3 years of free cash flow. So I'm getting decades worth of reserves, production, cash flow, free cash flow, dividends for free.
And as these companies start to buy back their shares after they've deleveraged, after they've paid the debt, well, shares are going to be hard to buy. So they're going to have to pay more. That means the stock has to go up.
Yeah, so long as they're trading well below whatever the company deems to be fair market value, which in our estimate is meaningfully higher than where we trade today. I think the average holding of my fund, I own 13 names in the Ninepoint Energy Fund, is just getting a price of about $58 to $60. So we're trading at 81, and I think we're ultimately going to 100 and meaningfully higher beyond that. So until they reflect where oil is trading at the time, you'll see buybacks. At that time, when we've re-rated, some names we see very, very, very meaningful upside in. At that time, then you'll see the pivot from buybacks to dividends.
Okay, so once they say we're not buying back because it's fair market value, they're going to switch to dividends.
Yes.
Is what you're saying.
Yeah.
Okay.
Because go ahead.
And it would be meaningful dividends at that point.
20% yields.
Yeah. Yeah.
Mind you, the price will be quite a bit higher.
It will.
So the dividend yield should come down a little bit, or will be down a little bit.
Yeah, we model every company in North America between $70 and $120 oil. And so I can tell you, generally speaking, what upside do we see depending on the oil price. We think ultimately the sector re-rates to a 10 to 12% free cash flow yield, which in a year's time is going to be the same as a 10 to 12% dividend yield, because it's going to be the same thing. But the thinking is, I think I'm being conservative. If a 10% dividend yield paid by a company with the strongest balance sheets ever, like debt-free, a little bit of debt, whatever, like super strong, with adequate inventory to pay me that for the next 30 years, like 10% yield seems like a good starting point for some semblance of fair value. And then we can kind of triangulate in terms of, how much lower that's going to go. But for many stocks, that's well in excess of 100% upside from here.
Yeah.
So can you comment, though, what's happening in the U.S., with the president and the administration saying, the oil companies are gouging us, so we're going to put a 5% surtax, 10% surtax, 20% surtax, or we're going to nationalize the oil companies.
Sure. Talking logic and politics is challenging. So you have an administration which on his day one in office, he killed a pipeline that would have transported the most ethical and one of the most cleanest barrels in the world to his refineries. So he cut that, meaning he doesn't want more production. Because at the time, EVs and transition, all this stuff for the progressives in his party. What does that lead to? What does energy ignorance on the part of energy policymakers lead to? Higher prices, because there's a supply shock. So then there's a very strong inverse correlation between gasoline prices and presidential approval ratings. And so we head to over $100. And he was like, oh, shoot, I goofed. So then he goes, well, okay, maybe we do need more supply for the next 4 years, while we're in office. Well, no one's going to invest in the sector when there's that much uncertainty. So now they're saying, well, those evil oil companies, they're not growing production. You have some congressmen and women that said oil CEOs should be put in prison for their climate crimes, and now they've pivoted 180 to say, please, please, please grow production because we're going to lose our jobs if you don't, because the gasoline price is going to be too high. So it's this flip-flopping. There's just so much unbelievable uncertainty. So the current president can call every CEO to the White House that he wants, beg for more supply. Ultimately, shale CEOs answer to their shareholders, who are the owners of the business. And so I met with one CEO about a month ago at a conference, and it was music to my ears. And he said, Eric, our job is not to balance the oil market. Our job is to make our owners, our shareholders, money. And so that's what it ultimately comes down to. It's our time to get paid for the misery of the past 10 years. Because yes, we've had a couple of good years, but this has been a soul-sucking place to have been invested, and it's our time now to be rewarded for the patience.
So are you saying then that if they were going to add taxes, the result will be lower production, because they're saying, look, if you're going to tax us, we're not going to increase production. So the price of oil will go up, the gasoline will go up anyways.
Yeah, so let's talk about profit windfall taxes in the UK, and the impact that had. So the UK came out and to Shell, okay, we're going to slap you with windfall taxes. I know you were almost on the precipice of bankruptcy with the sector in 2020. You're finally making some money. We can't have that, because it's impacting gasoline prices. We'll slap you with a windfall tax. We'll use that money to rebate energy consumption. So it's the stupidest thing to do in an energy crisis. So what did Shell say? They said, okay, you're going to slap us with windfall taxes. We had 24 billion pounds of investment planned. It's now a donut. So there is a consequence from energy and ignorance on our policymakers. Like I traveled to the Middle East in January. I met with the energy minister of Saudi Arabia, of Qatar, various other ministers too. And they get it. So I don't know if it's just they're better trained or they're closer to areas of real demand growth or they're major producers or all of the above. They're just, they understand. Versus in Canada, we have to apologize for producing a product where, think about what would life be like right now if we didn't have oil? Like we'd be back in the Stone Age, quite literally. And so we don't have to apologize for that. We have a sector that has pledged to reach net zero by 2050 using existing technology. Governments have to step up a little more. We have a environmental sector or standards where the UK, when they first discovered oil in the North Sea, it's a new industry. They had no policies. They didn't know. They looked around the world to see who has the strongest stewardship, and they adopted Canada's policies for that. And so it's such a massive, massive display of ignorance in terms of you come out with these taxes and you think that's going to solve things. Sure, maybe for like 3 or 4 months you'll buy off votes, but ultimately it just elongates the crisis that we're in today.
So historically in Canada, companies pay higher dividends than in the US. Bank stocks are paying 30, 40, 50% of their payout ratio. You're talking about close to 100% payout ratio.
Yes.
So something that's, I can't, Claude, you probably can't, but I can't think of something off the top of my head that would be similar. How do you foresee that happening? And you talked about it happening once the valuations were normalized, which will happen with buybacks. So you see buybacks for a period of time, then increased dividend yield. And do you see them kind of calling special dividends, or do you see them just kind of slowly raising them across the book? Because they're not going to need the cash, right?
No. So the model, my hope, if I have anything to say about it, is going to be drive the re-rating by buying back every single share using every nickel of free cash flow. Drive the re-rating. So in every stock, it's varied in terms of upside. We get into trouble if we talk about upside, but if you're 20% free cash yield, I think you're going to re-rate to 10. Well, that's 100% upside. Well, we have names trading at 30, 40, 50% free cash yield. So you get a quantum for how much upside. So drive that. At that point, switch from buybacks to dividends. And when it comes to a dividend, there are two parts. There's the base dividend, which is always set on a very, very low oil price so that it never has to be cut. It's a bedrock.
You don't want to be cutting the dividend.
Never, ever, ever do you want to cut that base dividend. But then there will be excess cash, so that'll be distributed in the form of the variable, which is what's happening in the United States now. Shale companies pay
That was going to be my next question.
Variable dividend.
The model that's happening in the US versus Canada. So Canada, so do you have more US names or Canadian names in your portfolio?
So I have two funds. They have two different objectives. So the Ninepoint Energy Fund, which is the third largest actively managed fund in the world. Second, we were the top performing energy fund in the world too the past 4 years. We are 92% Canadian because we think Canadian energy stocks are the most mispriced stocks worldwide.
Penalty box.
Massive because of federal policies, lack of egress, pipeline capacity issues, a variety of different reasons.
Is there a global sentiment that like we're kind of socialists and we're kind of...
I have to be careful treading that topic, but my suggestion would be there's probably a political risk discount being applied on our equities, which maybe one day will be resolved, maybe not.
Okay.
But I look at names where we're trading at a probably one turn discount to US peers. So if the goal of the Ninepoint Energy Fund is to maximize upside, given where oil already is, let alone where I think it's going, then that takes me to Canada because our names, I can buy decades worth of free cash flow for free. We also have an income fund where we want to maximize distributable monthly income. And so we're 75% US shale names because those models are low to no growth, maximum free cash flow. Instead of buybacks, it's now variable dividends. So we can make, we think, anywhere from 7 to 9, 10% yields between 70 and 100, and then we sell calls and make 15% annualized off of that as well.
Okay. Claude, has this happened in another industry? I'm trying to think.
Well, okay. I remember the 90s when nobody wanted to own a tobacco company.
Absolutely. Yeah.
And I want to compare oil to tobacco.
It's a great analogy.
Okay.
Yeah.
So I remember where they kept telling us as advisors, you can't put tobacco, sell everything. And at one point, nobody had a tobacco stock in their portfolio, which reminded me a little bit about the oil back in the spring of 2020. And all of a sudden, back in the mid 210s, 215, I look at the best performing asset class for the last 25 years. And obviously, the tobacco companies were the best performing asset class because they were trading on their terminal value. Even if you paid $20 for a stock and it was worth, people said it'll be worth zero in 10 years or 20 years because nobody will smoke. Even at $20 is what they pay, you're still going to get a return of 20%, even if you get back zero, when there's no more tobacco. Anyways, they still make tobacco, but I'm not trying to say it's the same as oil, but that's what it makes me think of.
The feeling.
And many people, I think, view oil stocks in the same as tobacco stocks. They're sin stocks, which is outrageously ignorant to me because everybody uses oil. And again, we have our way of life to enjoy it. And I firmly believe we will be using oil for the rest of our lifetimes. So it comes down to who do you want to be producing it? Do you want it to be Russia that doesn't value the environment and uses its revenue to buy cruise missiles to kill kids with? Or do you want to be Canada where we have the highest environmental standards of the world? Because somebody's going to produce it. Who do you want it to be? But I would view, most people think of it as oil stock, sin stock. We're transitioning, we're all driving EVs. There is terminal value discussion. And tobacco stocks were wildly the great performers for a long, long period of time. If you pull up Philip Morris, it was a great performer. Then they bought Juve, took a big write down, and then it's good performing again. But the model is going to be the same. it's low growth from production, even though demand I think will grow. Like again, we just had the U.S. government through the EIA say under every scenario they model, we will be consuming at least the same of oil in 2050 as we do now, and that came out today. So even in a low to no growth environment for demand, low to no growth business model for production, given the amount of free cash flow that's being generated and what the stocks are being discounted to, we see that same kind of dynamic playing out where it's that commitment to maximize free cash flow, pay it out, that will drive a very meaningful re-rating of these stocks.
But what if the industry was nationalized?
Yeah, so Canada is different. They worry about windfall profit taxes comes up a lot. And I think people reasonably say, well, it's happening in Europe, why can't it happen here? And, we've got certain ministers that scale the CN Tower and all these crazy things. So like, why couldn't it happen? So we've got to, and I have to say that with a straight face. So we have to appreciate the differences between Canada and other jurisdictions. First is this sector is about 15% of our economy, direct, indirect. Secondly, so it's important. Secondly, we already have windfall taxes in that we have a sliding scale royalty, meaning as the oil price goes up, our oil companies pay more. So it's not static. So that's very different. Third, we do have West versus East tensions, irrespective of what our justice minister just came out with, rambling yesterday, but well, maybe they'll take away provincial jurisdiction over resources and such. We don't think, like that would be the nuclear bomb between East versus West. And then lastly, we do have a supposed windfall tax. It's kind of like the Eric Nuttall tax because it's on buybacks, which I've been the biggest champion of, coming into effect next year. So it's a 2% tax on buybacks. So that was probably meant to placate certain elements within certain parties that want to come out and just slap windfall taxes on a sector that's finally making money after the misery of the worst bear market in its history.
I mean, buybacks, and I know we have to wrap up here soon, but like anyone who disagrees with buybacks basically, or thinks that like they can't do math, right? It's a math. If you have X profit and you have less shares,
Yes.
you have more profit per share. It might not be reflected today in the market, but we all know at some point the value of a stock is its future cash flow. So I want to ask you real quick about what you think the impact of the lack of buyers of stocks has on the sector for the next while. Do you think that the university endowment funds and the going away from buying any oil and gas stocks is going to have a material impact on the supply side, on the demand side of stocks?
So the whole divestment initiative, I live in Toronto, so like U of T, there are students in the Defend Wisdom voted, we don't want to own energy, and
Their portfolio's hurting a little bit.
Absolutely it is. Yeah. Set that aside. So I was going to go down a dangerous rabbit hole there, but the selling pressure from divestments has come and gone. So what we're really facing is there a buyer strike? There's just the inability to buy energy stocks because of the whims of investors, ESG pressures, wokeism, whatever it is. And that's a fair question. I do think that the pendulum will swing and you will see funds flow coming back. Look, for example, a bank just had Synovus and Suncor through Europe, where before, you would have been lucky to get 3 meetings. Well, now they had 2 days packed of meetings. And so why is that? Well, as Canada, we've pledged net zero by 2050 and not using, some technology on the come, like existing technology. So that commitment is huge because I think that allows Europeans to once again buy energy stocks, Canadian energy stocks. But again, I go back to what's the power of meaningful buybacks, 20, 30% of your shares through NCIBs and SIBs. It is that you have to drive the rating. So you need not have anybody care about the sector ever again in order for stocks to go up meaningfully, so long as boards use their free cash flow meaningfully in the form of buybacks. So it's additive, and I do think we will see funds flow return, especially if volatility in oil kind of lessens, but we don't need it. It's additive to the buying power eventually, because the boards, the companies, the free cash flow is so monumental that it in and of itself represents enough buying power to re-rate stocks.
It's going to be stronger than the divestment.
Yeah.
I do think, I kind of slightly disagree with you. I don't think we're done with the divestment selling pressure. Did I understand you correctly?
I think so. I think we are. Yeah.
You think we're done?
Show me a pension fund that's long, whether it's the Quebec, I forget the acronym. Every university endowment fund has liquidated.
I still think there's a portion of the global funds that haven't divested yet that they're going to get pressure over the next 2 or 3 years. Anyways, I don't think it's going to matter materially because the free cash flow eventually will speak louder than any divestment pressure.
Sure.
Well, I would say most of them have. There might be a few, but most of them have divested already. So they got to come back. Anyways,
So, go ahead, but we're running out of time.
yeah,
So I just
go
want to
ahead.
respect
You go ahead.
Eric's time. Last, the reason you're bullish in 30 seconds boils down to free cash flow, re-rating of the stocks, tons of buybacks, which will lead to huge dividends, and Canadian companies that are going to, potentially double or triple and have a 10% yield. That's kind of what you see in the future.
Yeah, I'm bullish because the demand for oil will grow longer and stronger than the average person believes. We'll be using oil for the rest of our lifetimes. I'm challenged to see where that supply growth is going to come from because U.S. shale is a couple years away from peaking. OPEC has exhausted its spare capacity. They're doing their best, but it's not coming online until 2025, 2027, and they're challenged to grow beyond that. And the global super majors, because of ESG and divestments and those pressures, they stopped investing in 2014. Investments fallen by almost half. And they have the inability, because it takes so long to bring on a new project, to grow supply between now and 2030. So there's at least a 6-year time period of this mismatch, this chronic undersupply in the oil markets. So then I relate that to oil stocks, where I believe energy stocks are discounting a price of about 60. We're already trading 80. I think we're going to end this year even under a US recession at multi-year low inventory levels that will eventually pressure oil price up. And so you need not be more bullish on oil because this sector can pay a 14% dividend at the current oil price next year. And if I'm right at 100, it can pay almost a 20% dividend next year. That's why I'm bullish.
I like it.
Guys, one more quick question. Do you see that there'll be a premium on Canadian or U.S. companies because they have cleaner oil, for the people?
Yeah, it's possible. And I've seen, certain people within the industry have talked about that. If there's ever a ethical premium or, if we're able to reach net zero status, you could see a premium placed on that, but that's probably in the distant future. Yeah.
Good stuff. Eric, thanks so much.
You bet.
Appreciate you taking the
Thanks
time.
for having me in.
Great.
We'll let you catch your flight.
Thank you.